Here we go. Silver just crashed 25.5% in a single session, from $114.43 at yesterday's close to $85.25 right now. That's a $29.18 collapse in less than 24 hours. If you're holding 1,000 ounces of physical silver, you just watched $29,180 evaporate from your position. But here's what mainstream media isn't telling you. This wasn't normal profit taking. This was a coordinated deleveraging event triggered by exchange intervention that exposed the structural fragility of the entire precious metals complex. We're not looking at typical volatility here. Three critical events just collided. First, on January 30th at approximately 3:30 a.m. Eastern, the Chicago Mercantile Exchange announced emergency margin requirement increases on silver futures contracts. Initial margin jumped from $18,000 per contract to $32,000 per contract. That's a 77% increase effective immediately. Maintenance margin surged from $16,000 to $29,000. Within 2 hours, algorithmic trading systems detected the change. By 10 a.m. Eastern, silver had already dropped from $108 to $92. Leveraged funds holding tens of thousands of contracts faced a brutal choice: post millions in additional collateral or liquidate. Most chose liquidation. The cascade accelerated through London trading hours as European exchanges opened to the carnage. Second, at approximately 11:15 a.m. Eastern on January 30th, a massive sell order hit COMEX futures. Market depth data from CME showed approximately 42,000 contracts, equivalent to 210 million ounces, executed within a 17-minute window. That's roughly 25% of global annual mine production traded in less than 20 minutes. High-frequency trading algorithms front-ran the liquidation, pushing bids lower with each successive fill. By noon Eastern, silver touched $75, a $39 drop from the morning high. That's a 34% intraday decline. Retail investors watching their screens saw their life savings cut in half before lunch. Third, this occurred during monthly futures expiry week, with January contracts settling on January 31st. Silver had rallied 140% since early December, from approximately $31 to over $121 by January 29th. Speculative long positioning in COMEX futures reached record levels. According to latest Commodity Futures Trading Commission data released January 24th, managed money held net long positions of 87,000 contracts. When margin calls hit during expiry week, those holding leveraged positions faced forced selling into illiquid conditions. The exchange data shows open interest collapsed by 31,000 contracts on January 30th alone. That's not profit-taking. That's systematic destruction of speculative capital. These three factors converged: exchange intervention through margin hikes, algorithmic liquidation of massive positions, and expiry-related structural pressure. This wasn't a market-finding price discovery. This was a structural break in the paper-silver mechanism that determines global pricing. Let's look at the chart. Silver opened January 30th at $114.43. By 9 a.m. Eastern, it reached $116.41 on continued momentum from the previous session's record close. Then the margin announcement hit trading desks. By 11 a.m., silver crashed to $92. After the massive sell order execution around 11:15 a.m., it plunged to $75 by 12:30 p.m. Current price sits at $85.25. The 50-day moving average sits at $63.20. Silver crashed through this level like it didn't exist, then bounced back above it in the afternoon session. This price level matters because it represents the average cost basis for traders who accumulated during December and early January. If silver holds above $63 through February 7th, it forms a bullish engulfing pattern after a spike low. This typically leads to a 15 to 25% recovery within 2 to 4 weeks. If it breaks below $63 convincingly and holds below for 3 consecutive sessions, the next major support sits at the 200-day moving average at $48.70. That would represent a 43% decline from current levels. The relative strength index flipped from overbought at 78 yesterday to deeply oversold at 19 today. Historically, when RSI drops below 20 during a primary bull market, the metal recovers an average of 32% within 45 days. That occurred in March 2020, September 2011, and April 2006. Volume on January 30th reached 306,578 contracts. That's the highest since March 16th, 2020, when COVID panic triggered similar liquidation. This wasn't low liquidity flash crash. Real capital, real leverage, real forced selling took place. Today's price action mirrors 2 specific historical dates: January 21st, 1980, when silver crashed from $50 to $42 after COMEX changed rules, and April 25, 2011, when silver dropped from $48 to $42 in minutes. Both times, silver recovered 65 to 70% of the decline within 90 days. The critical level to watch is $96. If silver reclaims and holds above $96 in the next 7 trading sessions, it confirms the January 30th low as capitulation and validates continuation of the structural bull market that began in 2024. Here's what they're not showing on CNBC. The premium between physical silver and paper silver exploded to levels not seen since March 2020. Physical dealers across North America reported spot premiums of $12 to $15 per ounce on January 31st. Normally, premiums run $2 to $3 over spot for generic rounds and bars. SD Bullion, APMEX, and JM Bullion all showed similar pricing. Physical silver traded at $97 to $100, while the paper market crashed to $85.25. That's a 14% premium. Why? Trading systems like Commodity Trading Advisors and Momentum Algorithms can dump 200 million ounces of paper contracts instantly. They don't care about physical delivery. They react to margin triggers and technical breakdowns. Contrast that. Actual metal requires mining at an average all-in sustaining cost of $23 per ounce, according to recent Silver Institute data, refining that takes 3 to 6 weeks, shipping via secure transport, and vaulting in allocated storage. When paper crashes while physical premiums spike, it shows real buyers seeing value that algorithms can't compute. March 16, 2020 provides the historical comparison. Paper silver crashed to $11.73. Physical premiums spiked to $8, meaning real metal cost $19 to $20. Within 90 days, convergence occurred as paper rallied to $18 by mid-June. The Shanghai Gold Exchange closed January 31st equivalent pricing at $91.60. That's $6.35 above COMEX settlement. This is the largest Asian premium since March 2020. When Asian buyers pay premiums above Western exchanges, it historically signals bottom formation within 2 to 6 weeks. Silver lease rates moved from 0.2% on January 28th to 1.8% on January 31st. That's the highest since September 2022. Rising lease rates indicate tight physical conditions as institutions compete to borrow metal for delivery obligations rather than purchasing outright in a falling market. Smart money moved before the crowd noticed. According to World Gold Council data released January 15th, central bank silver purchases tracked through sovereign wealth funds and monetary authority disclosures totaled approximately 87 million ounces in calendar year 2025. That's the second highest annual total on record. India's Reserve Bank added silver for 11 straight months through December 2025, accumulating 14 million ounces. China's State Administration of Foreign Exchange increased reported silver holdings by 18 million ounces in the third quarter of 2025 despite ongoing trade tensions and capital controls. Today's crash revealed institutional positioning through exchange data. According to Bloomberg Terminal Data tracking exchange-traded product flows, silver ETF outflows on January 30th were approximately 6.3 million ounces. That's heavy but not catastrophic. During silver's rally from $31 on December 2nd to $121 on January 29th, ETF holdings grew by 43 million ounces. Simple math, 6 million went out yesterday. 43 million went in over the prior 8 weeks. Net position remains massively long with 37 million ounces of new institutional capital still holding. Contrast retail behavior tracked through social media sentiment analysis and dealer surveys. Retail panic selling dominated January 30th and 31st. Online forums showed capitulation language. Dealer buyback programs reported 3 times normal volume of customer selling. Keith Neumeyer, CEO of First Majestic Silver, posted on January 28th at 11:47 a.m. Eastern. The paper market has completely detached from physical reality. Our mine costs are $21 all in. We're selling every ounce we produce at spot minus refining. We're not panicking. Major industrial consumers locked in forward purchases at $95 to $105 in mid-January, according to CPM Group data. They aren't panicking. They see the real supply situation. Speculators reduced net long positions by 18% in the week ending January 24th per CFTC data. They still hold 69,000 net long contracts. Peak speculative positioning during the 2011 bull market reached 112,000 contracts. We're not in euphoria territory yet. Today flushed out weak hands, over-leveraged momentum chasers, and algorithmic trend followers. What remains? Long-term holders who accumulated below $50, value buyers stepping in at $85, and industrial consumers securing supply. New accumulation is happening now in the $75 to $90 range based on reported dealer bid-ask spreads tightening after the initial crash. We've seen this exact pattern before. In January 1980, silver experienced a nearly identical crash. Let me walk you through how it played out. The parabolic rise, September 1979 through January 1980. Silver rallied from $11 in early September to $50 on January 21st. That's a 354% gain in 4.5 months. It was driven by Hunt Brothers accumulation, Soviet invasion of Afghanistan creating geopolitical fear, and inflation fears from oil price shocks hitting 13% annual consumer price inflation. Sound familiar? Silver just moved 140% in 8 weeks, from $31 in early December to $121 on January 29th. The exchange intervention, January 21st through January 23rd, 1980. On January 21st, COMEX announced Silver Rule 7. The exchange restricted new long positions to liquidation orders only. No new speculative buying permitted. Silver crashed from $50 to $42 in one session. Then compared to today, we dropped 25.5% from $114 to $85. The regulatory squeeze January 24 through February 1980. Silver recovered to $48 by January 28th as physical buyers stepped in, seeing value. It regained 12% over 7 days. Physical premiums spiked to $5 to $7 over spot, just like today's $12 to $15 premiums. The final capitulation, February through March 1980 during economic uncertainty and credit tightening. Silver moved its final leg down from $48 on January 28th to $10.80 by March 27th. The total journey, silver went from $11 in September 79 to $50 in January 80 to $10.80 in March 80. Right now in 2026, we are in stage 2. Make the comparison between 1980 and 2026. Peak price, $50, then versus $121 now. Trigger event, COMEX rule change preventing new longs then versus CME margin, hike 77% now. Percentage drop in first wave, 16% then versus 25.5% now. Support level, $42 technical support at prior consolidation, then versus $63 at 50-day moving average now. Premium behavior, $5 to $7 physical premium, then versus $12 to $15 physical premium now. Based on historical timing, it took 7 days to go from stage 2 intervention crash to stage 3 relief rally in the 1980 example. The expected window for 2026, February 3rd through February 14th. If proportional to 1980, the 1980 sequence recovered 25% from the crash low. That would be 25% from $75, which was the intraday low on January 30th, reaching $93.75. Conservative estimate, a 15% recovery from $85 would target $97.75. Key difference. In 1980, inflation was peaking, but industrial demand for silver was declining due to recession. Federal Reserve Chair Paul Volcker was actively tightening monetary policy with interest rates above 15%. Now in 2026, industrial demand is accelerating through solar panel installations growing at compound annual growth rate of 18%, electric vehicle production requiring 0.8 ounces per vehicle, and defense electronics manufacturing expansion due to geopolitical tensions. Monetary policy remains accommodative with Federal Reserve holding rates at 3.5 to 3.75%. This works in favor of bulls structurally. However, the 1980 situation didn't have a structural supply deficit. Global mine production in 1980 was 340 million ounces against demand of 310 million ounces, creating surplus supply. Today's context is structurally different. Mine production for 2025 reached 847 million ounces, according to Silver Institute preliminary data, while industrial demand alone hit 632 million ounces. Investment demand added 184 million ounces, and jewelry took 96 million ounces. Total demand, 912 million ounces. Total supply, including recycling, 891 million ounces. That's a 21 million ounce structural deficit draining above ground inventories. The pattern doesn't repeat exactly, but the sequence of exchange intervention, forced liquidation, physical premium expansion, and eventual price recovery remains remarkably similar. Let's make this personal. If you're holding a traditional 60-40 stock and bond allocation right now, here's your situation. The S&P 500 dropped 1.2% on January 30th. 10-year Treasury yields jumped 14 basis points to 4.62% as bond prices fell. On a $500,000 portfolio, split $300,000 in equities and $200,000 in bonds, that's a $3,600 equity loss and approximately a $2,400 bond loss in one session. Combined $6,000 hit if yields rise another 50 basis points to 5.12% as Goldman Sachs projects for first quarter and equities correct another 5% on growth concerns. that 500,000 becomes 468,000 over the next 60 days. That's 32,000 lost. The real-world cost, mortgage rates tracked to the 10-year yield. At 4.62% for a 30-year fixed mortgage on a $500,000 home loan, monthly payment is $2,573. If yields hit 5.12%, that same loan costs $2,729 monthly. That's $156 more per month, or $1,872 per year. Over 30 years, this becomes $56,160 in additional interest paid. The contrast. Those who accumulated physical silver at $31 in early December and held through the rally to $121, then watched the crash to $85, still hold positions up 174%. Even after the 25% crash, their 1,000-ounce position bought for $31,000 is now worth $85,250. That's $54,250 in gains. Institutional money saw this coming. India's Reserve Bank accumulated at an average price of $42 based on disclosed purchase timing through mid-2025. China's SAFE added at prices ranging from $38 to $56 during third quarter 2025 when sentiment was terrible and most retail investors were bearish after silver had languished below $32 for over a year. They positioned when silver was consolidating between $26 and $32 during the summer of 2025. The window just opened. Not because $85 is the bottom or $96 is the top. We don't know if $85 holds or breaks to $75 or $63. The window matters because of the structural deficit. Every solar panel installed removes 0.75 ounces of silver permanently from available supply, according to Silver Institute technical specifications. That silver is encapsulated in photovoltaic cells for 25 to 30-year lifespans. Every electric vehicle produced requires 0.8 ounces in electrical contacts, circuit boards, and battery management systems. Every defense system, from F-35 fighter jets requiring 523 ounces per aircraft to hypersonic missile guidance systems requiring 12 ounces per unit, locks metal into military stockpiles for decades. This is not speculative inventory sitting in ETF vaults that can be sold back when sentiment shifts. This is not paper contracts that can be created with keystrokes and destroyed with margin calls. It's physical metal consumed in use cases for decades. The 21 million ounce annual deficit means above-ground inventories tracked by exchanges and depositories are declining 3.2% per year. COMEX registered silver inventories, the portion available for delivery against futures contracts, total 53 million ounces as of January 28th, according to CME data. At current deficit rates, those inventories represent 2.5 years of deficit coverage. The question isn't whether volatility persists. The math is clear. Real question. Are you positioned for what comes in the next phase? In every previous cycle, hard assets preserved wealth while paper currencies eroded. Right now, silver sits at $85.25. The 50-day moving average is at $63.20. The next 7 trading sessions through February 7th determine whether this was capitulation or start of deeper correction. I share real-time updates on social media. For those wanting members-only analysis, there's a deeper tier. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the mathematics speaks for itself. Before you go, 3 things. 1. Comment below where you're watching from. Your price prediction for silver by end of February. 2. Subscribe for data-driven content. I'm fighting copycat channels stealing this content. If this provided value, comment data over hype so the algorithm knows. 3. Next video drops tomorrow. I'm covering the one indicator that predicted the 2008 financial crisis called the March 2020 COVID crash, and nobody's watching it right now. It just triggered again 48 hours ago during this silver collapse. Last time this happened, the recovery rally delivered 68% gains in under 90 days. You won't want to miss it. See you there.